Right. So I said the important thing to remember, please remember to carry your, once you make a fair value adjustment, remember to carry that value, whatever the value is at reporting, carry it to where it's supposed to be in your financial statement. That will be very important to remember. Now, if we move on, like we've discussed, we said that, so the paradigm's policy is to value non-controlling interest at fair value at acquisition, and the share price is 1.2 relevant to that non-controlling interest. So we have it in two places. So we can come to our NCI now and do fair value at acquisition. So our fair value at acquisition will be equal to 1.2. How many percent is NCI? Remember what we said earlier, multiplied by 25%, right? 25%
Yeah, 25%.
of the 20,000.
20,000.
Yeah, so we can come and put that. So it's equal to 1.2 multiplied 25% multiplied by 2123. And that's our figure for the non-controlling interest at acquisition. It will look like this. Okay, so that figure now, remember that we're going to carry that figure. So we can copy that figure. Remember that it will be part of our purchase consideration. So we can do, remember how we said our goodwill will look like. We'll have our purchase consideration plus fair value of NCI at acquisition. So that will be equal to that figure we just calculated. So it will go in two places. So technically that's the debit and credit. This is the credit NCI and that is the debit goodwill. So that's that. So that's all. I'll just wait till the end and then close those figures so we can move on. Then we now go to the note 2. And so Paradigm sold to Strata. So parent sold to subsidiary consistently 4.6. The Paradigm had marked up this at 15% on cost, which is the important thing we're going to discuss. So since acquisition, each month since acquisition, so really if we're doing, and I will do this just for completeness, even though it won't affect us in our discussion, but just for completeness, I'll show you how we normally take this. So when we're doing it with another question where it might have more input, then we would appreciate what is happening. So work 8, because we're not doing the group profit or loss, that will not be very important. So we'll do our intra-group sales. So we had 4.6 million, Abi. So we have 4,600 multiplied by, how many months do we have? 6 months, right?
Months, yeah.
So 6 months in the acquisition period. So that will be equal to 4,600 multiplied by 6. Now this figure, what we would have done if we were preparing, so in our profit or loss, what we should have done would be to debit revenue. So we'll reduce revenue by that figure. So when we do profit or loss, you will see this coming. Now, because we're doing a consolidated statement of financial position, and we're not doing the profit or loss, then because these two figures will knock each other out, it doesn't have any input on what we're doing. So we'll ignore that part. Do you understand what I'm saying? Revenue reduced by 27,600, cost of sale reduced by 27,600. The effect is 0 on our retained earnings because the retained earnings are not affected by, since it's minus, you minus from here, minus from there, two of them will cancel each other out. However, what is important to us is the unrealized profit. So I don't want to call the unrealized profit another working. Let me just call it, let me put it under this place. So unrealized profit now, I will just write a small note under it. So the unrealized profit.
Mr. Brian, but you didn't do the math, recognize the 15%.
No, I've not calculated it yet. I'm coming. So the unrealized profit only affects or is only calculated for the intra-group sales that have not gone outside the group at the date of reporting. That's the only part. So in this case now, I think they told us 1 month is that the subsidiary has 1 month, Abi. They said,
yeah.
I can't see it again. Okay, Strata had 1 month supply. So in this case, only the 1 month supply held by Strata at the reporting date will be considered. All right, so that's that. So the way to structure this now is to do our markup and margin. Ella, so we're back to your 15%. So what we'll do now is, let's do our markup and margin the way we structured it. So we'll have revenue, cost, and profit. If you've forgotten it, then don't panic. Let's just go through together. So we'll have...
I've not forgotten.
Okay. So we'll have absolute. That's the dollar value. And then we would have percentage. Unfortunately, I can't write some things on Excel. I'm going to write them, and you don't have to show all this working when you're doing this. Now, what's important?
You have just written percentage sign now.
If I write percentage sign, it will not allow me to go in Excel. It will ask me what I'm doing.
Okay.
So you don't have to write all these things. If you know what you're doing, then just do it directly. Okay, now, then remember it is parent that is selling to subsidiary. I will explain some things as we go forward. It's parent that is selling to subsidiary. So we're going to look at the markup, who is selling and what is the markup that person is giving. So in this case now, the parent has marked up these sales by 15% on cost. Now, if parent is selling to subsidiary, what is this to the parent? What is this? Is this a sale or a cost? Is it revenue or cost to the parent?
15% is
No.
revenue to the parent.
Revenue to the parent. So what I can say is, since it's revenue to the parent, then we'll come here. Now remember, it's 1 month sale. So revenue to the parent in absolute terms is that 46, right?
Yeah.
In terms of percentage now, this is a markup to the parent. So what is the markup? What will be the percentage value for markup?
It's 115 now.
115.
115.
So 115%. And then we know that the cost in percentage terms will be what?
100.
100.
And then the profit will be what?
15.
15%. Thank you. So therefore,
Okay, why are you laughing?
The boss.
so therefore,
Cost is not the egg.
the profit now, unrealized profit, the unrealized profit, which is our profit now, that's the profit we calculated. So that's that profit in that sense. We can do the cross multiplication, will be equal to, and we can do 15 divided by, what's that now? 15 times 46 divided by divided by, if we're
115.
cross multiplying with our I, divided by 115, Abi?
115. Yeah.
Yeah.
So that would be 4,600
No, it's 600.
multiplied by 15
Okay.
divided by 115. So if we come and do that computation, so it will be equal to 46. Taye came and left times 15 divided by 115. So that gives us 600. So this 600 now, that's where the work is now coming to. So your accounting entry for that 600, and please remember this one, we'll debit and we'll credit. So we'll debit our cost of sales. Now it's parent that sold to subsidiary, Abi?
Yes.
Yeah.
So we'll debit our cost of sales, put in bracket, that's the same thing as debiting our group retained earnings because it's cost of sales. So it's the same thing as saying group retained earnings, and we'll debit that with the 600. And then we'll credit our inventory. We're reducing, remember inventory should be valued at the lower of cost and net realizable value. Since the cost to the group is 600 less than that 46, so the cost to the group should have been 4,000 because the parent sold at a markup of 600. That's why in the group now, in the subsidiaries position, is recognizing that inventory as 46 instead of 4,000, which is what it was, which is what the cost to that group was. So if we go back to our IS2, that's what we are basically doing. We are writing down the inventory to its cost, not its value after the sale from parent to subsidiary. Do you get the point I'm making?
Yes.
Yeah.
Yes.
So we're reducing inventory by 600 because that 600 is an unrealized profit. They've not yet sold it. It has just been transferred from one side of the group to the other side. They have not yet sold it, so we can't recognize that until after it is sold out. That's why the ones that are sold out, we don't bother about them. We have already realized that profit, but this profit has not been realized. So what we are going to do is to go to group retained earnings now. I think we've already put parent retained earnings. Yes, we did. So we have unrealized profit.
Deduct from the parent.
Yeah. Unrealized profit. What was that? Work 7, I think. Work 7 or work 8. So work 7. Let me call it work 7. If I check that, it's not. And remember that it's
The
supposed to be
workings have
negative.
workings in it.
Yes. Just to, and why I'm doing all of this is just to help you when you're reading. So it's equal to negative, and then I go and look for that figure. The figure was 600. So I want it to be negative. And that's that. Work, what is this? Started this work 8. Okay, so I'll adjust that. So that's work 8. And then I'll go to my inventory now for the next part. Remember, I said I was going to reduce inventory. So go up to inventory. Where's inventory? Inventory here. So I'll say is equal to, and I still want it to be negative because it's reducing. And then I go and pick that figure. So that's 600. All right, so we're done with that. So that's how, that thing, what I've just done now is something you're going to have to learn because you must see it in the exam. Either you're doing consolidation like that or you're doing it in another way. This is something that will come out in consolidation, guaranteed that you'll see an unrealized profit. So if you're doing the profit or loss, then you have 3 of these entries going in. Let me go back again. If you're doing profit or loss, if you're doing a group profit or loss, then you have 3 of the entries going in. First of all, the revenue, you reduce revenue by the whole, you reduce cost of sale by the whole, and then if you have unrealized profit, then unrealized profit will go to cost of sales. So you add back to cost of sales. So you will remove 27,600 from cost of sales and add 600 to cost of sales if you are doing a statement of profit or loss. But if you're doing a statement of financial position, then all you will need to do is reduce retained earnings by 600 and then reduce inventory too by 600. Is that clear? Why this doesn't affect your statement of financial position, like I said, 2 of them we cancel out. So if they cancel out, there's no need to put them. I've just put this for completeness because of the future questions we'll do. All right, so we're good. So we move on. We're almost there now. And then the next question says that Strata's current account balance with Paradigm at the end of the year was 2.8, which did not agree with Paradigm's equivalent receivables due to a payment of 900,000 made by Strata on 28th March 2013, which was not received by Paradigm until after the end of the year. So in this question now, all we're doing is so if Strata's current account balance with Paradigm, Strata is saying, so it's payables and receivables. So Strata has 2.8 in, so receivables, payables, and then the cash adjustment. Do you get what I'm saying? So let's come and do our working for work 9 now.
I'm a bit confused.
For this one or for the other one?
Please, please go up a bit.
Okay, please. I'm coming. All right. So you said I should go up. I'm up.
Yes. Just hold on. No. Yeah. This absolute and the percentage. This revenue is gotten, but this 115 is that as a result of this 115?
Yes, because
is that
of
a result of?
Yes.
You added the cost and the profit to get the 115.
Yes, that's how we look at it in percentage because it's a markup.
Okay, but where is the 100 coming from?
If you say markup, then your percentage on a markup, your cost is 100%. Will be if it was a margin on the other hand, then your revenue would have been 100%.
Okay.
All right.
Thank you.
You're welcome. Any other thing? So we can move now, Abi? I don't know if my question has disappeared.
We can move so that 9 will be done. Okay.
Yes, we're almost done, sir. I've lost my question now. And this soft copy thing is difficult for me. 1, 1, 2, 1, 2, 1. All right, so our receivables and payables now, that's where we are. All right, that's Paradigm. Oh God. All right, so our receivables and payables. So we will first of all remove the 2.8 from each of them. We'll first of all remove the 2.8. So we'll debit receivables and payables. We'll reduce them by the 2.8, and then we'll now add back the cash because the cash is missing from the group. Is that clear? Can you hear me?
Cash, which cash? The 900.
The 900 cash is missing from the group.
Okay. Equivalent receivable due to which was not received. No.
All right, please just give me a sec. Can you hear me? Let me go on it.
Yeah.
All right. So we'll debit receivables. We are going to debit payables now. We're reducing the payables because that's not a true transaction. And then we'll credit receivables. by 2,800 each. So reduce both of them, 2,800. Can you hear me?